So the stock market crashes and trillions of dollars just vanish. But money can't disappear into the void, right? Where does it actually go? The answer is, it doesn't go anywhere, because most of it was never really there to begin with. Think of it like this. You buy a Picasso for $1,000,000 because that's what everyone agrees it's worth. Tomorrow, art critics decide abstract art is overrated and collectors will only pay $500,000. Where did your other $500,000 go? Nowhere. Same painting, same wall, but the collective agreement about its value just shifted. No money changed hands. The wealth simply evaporated when opinions changed. Most of the money in your portfolio isn't actually money at all. It's paper wealth, the theoretical value of what you own based on recent trading prices. When Tesla stock goes up 10% and Elon is suddenly $20 billion richer on paper, he didn't get a PayPal notification for $20 billion. His shares are just theoretically worth more based on what the last few traders were willing to pay. But here's the catch. That valuation only holds if you can find someone willing to pay that price. And during a crash, good luck with that. This is why market crashes hurt so much. When everyone panics and tries to sell simultaneously, there aren't enough buyers at current prices. It's like musical chairs, but instead of chairs vanishing, the people ready to buy your stocks are gone. Prices crash because supply suddenly overwhelms demand. The shared agreement about what things are worth breaks down, and everyone realizes the emperor has no clothes, or at least fewer clothes than we thought. Some real cash does move around during a crash. Investors who sold early and moved to cash locked in their gains before the drop. Those scooping up stocks at rock-bottom prices are putting real money on the line, betting the market will recover. In the end, the only real wealth transfer is from panicked sellers to patient buyers, and from over-leveraged traders to their creditors when margin calls come due. The Federal Reserve understands this dynamic. When crashes happen, they don't just shrug and say, well, those trillions are gone forever. They inject fresh liquidity into the system, essentially providing the cash that makes it easier for buyers and sellers to find each other again. They're not replacing lost money because that money was never physically lost. They're providing the confidence and liquidity needed for the collective agreement about asset values to stabilize and rebuild.
Like what? What?
Here's what this means. Most wealth in modern markets exists only as long as we collectively believe it should. Your house value, your retirement account, even the dollar in your wallet. They're worth what they're worth because we all agree they should be. This isn't some conspiracy or flaw in the system. It's actually how all value works in human societies. But it does mean that when confidence breaks down during a crash, enormous paper wealth can vanish almost instantly. Now, before you dismiss this as just numbers on a screen, remember that paper wealth has real consequences. It affects retirement plans, college funds, business investments, and economic confidence. When people feel poorer, they spend less, which affects actual jobs and real paychecks. So next time your portfolio crashes, remember, your money didn't vanish. It just moved to someone who was less panicked than you. I am your host, Mr. X Banker. Thanks for watching, and I'll see you in the next one.